All right, good afternoon for those that are in East Coast time. I'm joined here by my friends Nick and Quinn. Everyone here manages money, manages risk. We chat pretty regularly. Thought we might share some thoughts on where we are in the market and going into the second half. And just by way of background, every morning, my team and I go through the market, our positions, factors that are working, different themes. And Monday morning is a very lengthy deep dive into a lot of this. And so we'll share some of the conclusions and what we're looking at, which I think might be instructive. And there's some other things we want to get into as well. We want to talk about, the US dollar rolling over, commodity rally. What does that mean for digital assets? ETFs. I want to talk about ETFs and why they're so powerful as far as the tax advantage savings, particularly if you have it wrapping an active manager strategy. Negative momentum rally, Fed rate cuts. What does that mean for small caps? I don't know if we'll get through all these topics. We got a lot. Quinn will join us for the first 20 minutes as well. So look, first off, I'll frame it up this way. I'm going to share my screen in a second. But what we're seeing is the following. It's an internal chart book. I kid you not, this thing has, you can see here, like 400 pages. It's quite a lot. So it's very effective. It's very helpful. And you can ignore some of these boxes here. That's just kind of internal language. It's not meant to be for external consumption, but it's useful for our purposes here. So, on the 10-year, we had that, vicious rate rally in 2022. Then it declined. And of course, you had an equity rally with that. And now you've got the 10-year that is doing a bit of a rally right now. You've got the US dollar, which is near its highs and looks like it may be rolling over just as the market is about to expect the Fed potentially to cut rates in September. That's currently what is expected in the market. And as you can see here, these red arrows are very simple to understand. When the US dollar is rallying, these are generally risk-off markets. So this red line coincided, as you can see here, with downside in risk assets. This green line with the dollar weekend, that was bullish, red line bearish, so on and so forth. It's good to just get a sense of things are playing out. And then here you've got Bitcoin. Bitcoin's a great indicator to look at for animal spirits and risk appetite too. So we'll talk about that, as well. Obviously, we've got indices at all-time highs. We like to look at every name in the Mag 7. If you want to get a basic sense of where indices are going, take a look at every single chart in the Mag 7. That will give you a perspective. Overall, I would say that, locally, in the context of the next few days, almost all of the Mag 7 names are overbought, except for NVIDIA. We did buy some NVIDIA this morning, by the way. And the other comment I would share is that we are in a period of extremely bullish seasonality the next 2 weeks, and also going to the July 4th holiday. That's notable. I would also point out that last Friday, we had the futures were green after the debate on Thursday night. And then there was really a give up on that rally, which is really unusual to see. It's really not the best kind of picture. And last week, there was some negative seasonality, although the market seemed to get through all of that. So I'll pause there. We can move through a few different topics here, but any quick reactions? Quinn, you want to dive in?
Yeah, sure. I've been keeping an eye on a lot of those metrics you watched, or you pointed out, the dollar, interest rates. It's interesting because, the yields I've heard attributed to both a Trump bump in growth and also, some of the things going on with maybe the Japanese yen and potential large holders of treasuries being forced sellers. But one of those, the Trump bump in growth is a good reason, for risk assets, for yields to be higher, right? Higher earnings, higher growth. So you wouldn't expect equities to get hurt on that. And the other one, a steepening yield curve, because, Japan needs to defend their currency. On one hand, also, it steepens the yield curve, but it weakens the dollar, right? If they're repatriating the proceeds from those treasury sales. So I think you have this dynamic here where as long as the Fed, right, yields are rising because there's inflationary pressures or growth pressures that are increasing, and the Fed is kind of communicating that they probably will still cut this year. And so as long as you get, I see it a positive next few weeks, and then really the decision point after that being if this rally continues into late summer is how confident the market is that the Fed will cut in September. And if that happens, I don't think it's smart to underestimate the liquidity growth and benefits to risk assets from getting a cut in September.
Nick.
Yeah, I think, I mean, going back to just the debate and everything, I think everyone has Ben Hunt from Epsilon Theory, it calls it the common knowledge game, but it's one thing to know information, but it's another to assume that people are going to act on it. And I think that's where we're moving beyond everyone talking about it to everyone knowing that everyone knows about it. And now it's actually moving into what's going to happen. And I think that's spurring some strategic debates now on the Biden camp. And what does that mean for Trump? What does that mean for, I mean, again, crypto, technology, everything. So I think it's causing this prompt of kind of slowing things down, where folks are trying to say, okay, how we know what's happening, we know what's going to happen, but what's going to happen the next 40 days? What's going to happen the next couple months here? So I think things are going to get compressed, and then things are going to expand further. So I think overall, I'm very bullish past the next couple weeks here.
Yeah, I want to share a few charts real quick, and we'll come back to kind of the Trump effect on asset prices. So one is I'm going to go to Brazil real quick, and this is related to the US dollar. And I'm going to share my screen here. In late December, I shared on X that Brazil is a really interesting market, but it's overbought. The basic idea is that the demographic population is expanding there, unlike many other countries in the world, and they have a maturing capital market. They also have multiple companies that are successful. Most emerging markets, you have one or two interesting companies, and that's it. Brazil's got several, and it's growing. So if you look at Brazil, at the beginning of the year, you had Brazil top out. This was also the period, if you recall, when everyone like Bill Ackman was calling and expecting the Fed to cut rates. The public hallucinated. The public thought there would be Fed rate cuts and a pivot in March, which never happened. We certainly didn't believe that would happen. And that coincided with the peak of Brazil, right? Now, look at where we are today. So here at the bottom, Fed rate cuts, I do believe actually are in sight. Somewhere September, November, December, we'll get a more precise view as we navigate through the data. And here the dollar is at a peak. And in my view, it's going to start to roll over, especially with the idea that the Fed will start to ease, right? Other central banks have been easing, and the US has kept their rates high. And so that's for the dollar. But with the US central bank throwing in the towel on rates, I do believe that's going to give a boost to commodities and other international assets. And that also in commodities like uranium, which are getting a bid now, right? So I'm going to shift here to uranium. So you see, once again, uranium right at support there, and quite a few different commodities. Let's go to Bitcoin as well. I like to look at Bitcoin because it really is a marginal liquidity market. And you can see Bitcoin is rallying here. Again, with that support in the 200-day. I see a lot of charts like that, by the way. 200-day coming up for support is bullish. Last Thursday, ahead of the debate, we did buy Grayscale Digital Large Cap Fund. And the basic idea was based on everything you're seeing here, right? Number one, dollar weakening, commodities rallying in concert. Any quick reactions to that, or should we talk about Trump and where we go from here?
I think as you point out, rightfully, using the dollars, the barometer of liquidity, particularly within the U.S. but globally, is how I'm looking at things, because we know every central bank across the world has been looking to ease financial conditions and stimulate. Everybody's slowing much quicker and harder than the U.S. And to me, once the Fed gives the green light, it gives everybody else room to stimulate further without sacrificing their currencies. And that's actually what probably ends up keeping the dollar fairly supported over time, is our economy remains stronger, for the foreseeable future. And personally, I'm fading any, there is clearly a slowing in the data, just enough to get the Fed to ease, but I don't think it's going to be very problematic for the overall health of the economy. I think with 5, 6, 7% fiscal deficit spending, it'll be tough to get a real recession.
Yeah, no, we got to take the data each coming week. I think I've seen so much intense pressure on the Fed to cut rates since August 2007. August 2007 was far more intense, by the way. That's when Jim Cramer was on CNBC, and he said, they know nothing. I see Nick nodding his head. I see Quinn smiling there, right? That was more intense, but I mean, everywhere you go, there's so much pressure. I don't think they'll cut rates, by the way. Neither does the market, although there's some sign to that. One other point I want to bring out here, I'm not making a political point here. My goal is just to do some analysis and identify risks and opportunities and kind of position appropriately. But, we had this thesis that we published several months ago. It's called like the Trump bump effect. It's the idea that that speculation on Trump in the next election is creating animal spirits in markets. And, you can see the State of the Union address here. I'm sharing my screen. That was a local peak in semiconductors. And right after, kind of declined, correction finished on April 24th. And then on Friday, after the debate, we saw indices and the futures were up. Ultimately, they gave back, but energy continued to stay in the green. And that's exactly what you would have expected, you would have predicted. And we made that same prediction Thursday night. So we're doing science here. We're not like doing backward looking and trying to fit the facts to a theory and a narrative. But one thing I would say is this, is that something people are not considering, I believe, is that, the Democrats will put up, I believe, some kind of candidate that's competitive and credible. And the conclusion from that is that if that's the case, and you have a legitimate contest and a real debate that plays out, then that creates risk of this, call it the Trump bump effect, fading. So that's something to think about, especially as you go into the summer months, right? We've got a strong rally. This is a very strong bull market. There's no doubt about that. The AI story is real. NVIDIA's got real earnings. And NVIDIA is actually cheaper than at other points in its history, okay? But that coinciding with seasonal weakness in August and September and the uncertainty of the direction of policy, I do think could create some weakness in the late summer, right? Now we got this great seasonality coming up, as I mentioned, now the next 2 weeks. And what do you see in the second week of July? Tech earnings, right? So, that could lead to some kind of peak sentiment moment. And then, maybe there's some recalibration. I guess on the bullish side of the ledger, I will say it's hard to spot opportunities of excess speculation in the market, right? Unlike what we saw summer of last year, you had a lot of nonsense stocks that were overvalued. I could pull up like ARC, for example, and that froth isn't quite here in the market. This is I'm going to pull up a 3-year chart. This is ARC. This is Cathie Wood's Innovation Fund. Incidentally, it's one of like the best market signaling tools that Cathie Wood has ever created. It's phenomenal. I don't know how they do this, the brilliance that's over there. But if you look at July 20th, this was a local top, intermediate top in the market. We're not seeing that this time around. What we are seeing is crowding into the very best names. We're seeing more of the best versus the rest rally, right? So crowding to themes and to thematic plays like AI and also GLP-1s. So the question there is breadth going to expand? When will breadth expand? And how does this relate, obviously, to the Fed and the timing and all this stuff? Thoughts?
Yeah, I've been of the view that it's the two-speed economy has kind of maintained, although less importance since 2022 when inflation's been coming down. But that concept is very much real. Financial conditions fall in that camp. They're very loose for the Mag 7 tech companies that have negative net debt, i.e., more cash than debt on their balance sheet. They're earning higher rates of short-term interest, and they have the cheapest cost of capital in the world. But financial conditions are extremely tight for the regional banks, the small medium-sized businesses. We're seeing this in employment data weakening the most at the small mid-cap level. So I think that green light finally for investors to get comfortable moving out the spectrum a little into small caps and the, let's say, wider breadth, not just the AI NVIDIA train, is liquidity and Fed accommodation. I think commodities and crypto fall in that bucket, and that's really what I'm looking for in terms of like that breadth expansion. As you point out,
we're seeing
yeah, go ahead.
I think we're going to get it, and I think we're seeing it now. In fact, you can see energy, financials, consumer discretionary performing, technology still performing as well. It is mixed, but I would say that this is a market with trends. You don't want to own things with bad trends. That's very simple. It's like, I don't think healthcare is worth owning, for example, right now. But the other part you pointed out there, Quinn, and is this two-tier economy. So we all know retail sales, or maybe people don't know, retail sales data has been atrocious the last 6 months. You can see stocks like Lululemon are down something like 40%. But boomer stocks are doing well. Here's Dick's Sporting Goods. Dick's a few weeks ago was like all-time highs, right? So boomers are spending. And we have a big thesis on boomer spend. Cruise lines are near all-time highs. So, after COVID, people wanted to stretch their legs and go spend on restaurants and travel. We've certainly seen that. So I do believe there is this two-tier economy effect that's playing
out. And they're earning 5% risk-free, so they have some money to spend. And I think that is another thing that we kind of know that is happening and will continue to happen is they were going through this kind of the past how many years trying to eke out like a 3% interest rate off of bonds or dividend stocks. Now they can get 5%, and they're spending as if they can spend 5%.
Right. No, I agree. If you look at small caps, this category hasn't gone anywhere in 3 years. I believe that when rate cuts are in sight, that we're going to see pretty significant rally in this category. And the reason why I say that is that there are just so many of these small caps that have weak balance sheets. They have way too much debt. They may not be able to refinance that. They cannot access capital markets in the same way a large cap company can. And I look at it, these small caps are like trading like call options because they might be worthless or they might be something. And if interest rates go down and they can refinance, they're actually worth something. So, catching the turn on this and repositioning at the right time is a bit hard. But if you find a great asset and a great business, and we certainly see them, especially in like the insurance category, we think there's some interesting ideas. And no one's talking about insurance right now except Warren Buffett. That guy knows the premium cycle pretty well. But I would say, keep an eye on small caps.
Ram, I have to jump here, but the last thing I wanted to just point out is you and I have been talking about this, but I'd say you generated the idea, and it's been spot on in terms of NVIDIA sucking the liquidity from every other asset class. And in some ways, it's made people think NVIDIA equals equities, when in reality, it's kind of more standalone, and it's actually more of a flight to safety in an environment where the dollar's been going up. So if you look at NVIDIA versus rest of the stock market and the chart of the dollar, I think there's some interesting takeaways there. But to the point on small caps, you get the Fed easing, you probably see a re-rate in those businesses, but there's also has to be, what would you estimate the wealth effect, of NVIDIA and other Mag 7 leaders, given their size and their gains and a percentage basis and market cap basis, and kind of being spread out to the rest of the market?
absolutely, right on the mark. Look, household balance sheets have never been stronger. We have record wealth in equities, and house prices have appreciated despite rising rates. So although there's this two-tier economy effect, by the way, it's the top 1/3 of consumers that drive the bulk of spending. So there's real pain out there. Inflation, is real. The cost of groceries is high, and that's impacted consumer sentiment. But the spend and the asset effects are strong. I went to I know you got to roll, Quinn, so if you got to drop off whenever you got to, but all good.
Yeah, thanks for having me. We'll chat a bit later. See ya.
I was at Ruth's Chris Steakhouse a few weeks ago. I think it was like a Thursday night. It was in New Jersey, by the way. It was not New York City. Okay, it's like Paramus, New Jersey, and every table was packed. The bar was totally packed. Then I said, is this corporate spending? Is this family? And there's a good chunk of families. And you could see the grandpa was somewhere, the grandma and grandpa were somewhere in there. So look, this is a boomer spend economy, right? I think that's a big feature. But this NVIDIA point that Quinn touched on, I would recommend you all take a look at this thesis we have. It's called the NVIDIA correction hypothesis. I'm going to share my screen on it, and you can look at this on Twitter or Google, type in NVIDIA correction hypothesis. Wrote about it initially on May 28th. This is the day after NVIDIA reported earnings. And, the thesis I shared there, I said, look, we're at risk of an unusual type of correction. I said, we may be in it now. And said, investors are waking up to the fact that they hold stocks that are more expensive than NVIDIA, but growing slower than NVIDIA. So they're going to dump that stock and buy NVIDIA. And that's what happened, right? If you look at WCLD, which is the ETF for SaaS and cloud, people are selling Snowflake. They were selling everything else to just go buy NVIDIA, which makes sense. That's rational. NVIDIA is cheaper and growing faster than all these other tech stocks. So what you had then is this breadth of deterioration. Now, what I didn't expect is this. I thought that phenomenon would be isolated to technology. It was actually the whole market. This is the NVIDIA effect. It's like Michael Jordan walks on to the high school basketball court, and he's just playing the game. Look, this is the green line, shows the performance of technology. You can see after NVIDIA's earnings, just carries the market cap up. Every other sector in the red, and this led to this breadth deterioration. So then the question is, well, hey, when does all this stop? It stops when NVIDIA stops re-rating. Arguably, that's happened, right? You had a big movement in NVIDIA, and now NVIDIA is kind of churning here, which actually helps breadth.
And it helps the options market too. I think with the liquidity in NVIDIA options, and there's probably been I would have to kind of check the full data on this, but my assumption is we are pricing more options being written on NVIDIA in both directions too. So that's just going to help determine, are folks going to do collars? I think there's probably a lot of protected puts being written. So there's single-sided stocks now for ETFs. We didn't really have this in previous times. So we have a real company, real profits, real use case, an expanding AI entire theme that's going to touch on energy that we kind of already talked about a little bit, semiconductors, who are the fabricators, ASML, TSMC. This is not going away. So what's next? Who's going to replace NVIDIA? And that's what I think people are looking for, and they're not really sure. So they're saying, what? Well, it's not yet time. It's not time yet. We'll kick the can another earnings. Right.
Now, here's another theme that we're seeing in the market, and it's something I've written about. It's called the negative momentum rally. And let's define what that means. So momentum's a factor in the market, right? Momentum, and I'm speaking very loosely here, there's actually a quantifiable definition for momentum. It's stocks that have gone up the most in the last 12 months, ignoring the last 1 month. Okay, that's a definition of momentum. And if you can sort on those stocks, and the stocks that are in the top 50% of that have momentum. The ones that don't, or the bottom 50% don't have momentum. That's the same thing as saying you have a trending market, by the way. It's like a momentum market. And momentum has been strong and overbought, and it keeps going. You see that with NVIDIA, right? But we are starting to see signs of this negative, not seeing signs, we are seeing it now. I've written a few times now, this negative momentum rally. Let me explain. So take a look at the S&P 500. Look at SPY. This is the S&P 500 trust. And let's take a look at the movers in this name. All right, we're back. We're back. Continue after that brief interlude. We broke the internet. I think we have like 1,000 people live here. So let me share my screen here. And we're talking about this negative momentum rally. And then, I'm showing here like the power of factors, how you position and think about what's happening in market. Look at Tesla and look at Apple. These are the biggest gainers in the market today. What do you not see here? You don't see NVIDIA, right? You don't see the usual suspects. In fact, you see Nike. Nike just has negative momentum, right? Dropped 20% on earnings. Broadcom's mixed, sure. Oracle's been a laggard. So what's happening is the laggards are catching up. I'm going to show you Paramount and WBD also. Paramount Global, these are streaming services companies. They've been getting hammered because they're struggling to compete with Netflix. But what you saw last week is like that category was rallying. And look at China, right? China negative momentum, right? These were rallying almost every day last week except today, right? So let's go look at China. That's FXI, right? You see a bit of a rally there, right? That's a negative momentum rally. So let's look at the actual chart of Tesla. So here's Tesla, and you can see that it's attempting to punch through its 200-day, right? So, it's important to be factor aware. I think a lot of people just look at like a chart or something like the fundamentals, but they're not paying attention to the music that is shaping markets. And I kind of think of like major chord and minor chord. Think of it that way, right? Major chord is like momentum is on. Minor chord is like negative momentum is on. And markets go back and forth. Last week, there was ping pong. You probably saw this, Nick. Remember, you had like, I think the first day NVIDIA was down and breadth expanded. Like everything but tech went up. Then the second day, the exact opposite happened. And we're still seeing some of that ping pong, play out.
I think for the next couple of weeks too. I mean, again, I think folks right now are edgy, and we have this mindset of we know NVIDIA is good, but everyone else knows it's very good. So when is that common knowledge going to change? And it's hard to change when there's actual data and fundamentals. But then in the back of your mind, you start thinking, okay, what else could be good from a supply chain standpoint? Who else is working with it? Who else is? And then that's where you start seeing some of the breadth come in with names that could resonate with the core concepts. So I think folks are just looking for the next NVIDIA, or it was several decades ago when it was trading under, just $30
right.
$40, right? So that's where, like, as soon as like NVIDIA mentions like, oh, they took a stake in something, but SoundHound was one of them, it just skyrockets up. Everyone's looking for what is next, and we all have this mindset of AI technology. And
I agree. I think people are finding another way to get exposure, and they're looking at this is expensive. So how else do I deploy capital? People are afraid to buy it at the top of the market, even though it's actually bullish if you look at like 6 month, 1 year out.
Yeah.
But it's, how do they get into position? I will say this, like, if NVIDIA does chop and go sideways like it has, it is bullish for other assets, including things like Bitcoin. And you can see Bitcoin rallying. because, crypto's a momentum asset and NVIDIA's got momentum. There's a momentum market. So whoever's moving the fastest gets the attention, gets momentum, gets the capital. It's kind of that simple.
Yeah, and especially now that there's ETF coming out, there's going to be, especially in I think folks with retirement, going back to the whole boomer mindset, they're the ones that have the largest allocations within their retirement accounts. They're the ones that are probably more self-directed. They're the ones that are outside of 401k plans. With the 401k plans, we're going to keep them more indexed, which also helps a lot of these key names. It doesn't help so much with the small mid caps. So I think there's more active management capabilities there too. So crypto comes on the scene now. It's not just for the folks that have the time or the motivation to learn crypto or to open up an account somewhere. Now they can actually say, this could be part of my strategy. How do I offset some of my technology risk without necessarily sacrificing the exposure?
Right. I agree. And we'll talk about ETFs in a moment. I'll give one parting thought on semis. Look, I think betting on AI via semiconductors is still a great thesis, especially if you have a longer term horizon. And people looking for catch-up plays in there. There are a few different catch-up opportunities. Here's one that we own and we like. We think technically it's attractive. It's called ACMR. You can take a look at ACMR. Got a forward PE of 14.6, which is much cheaper than almost all these semiconductors that are out there, and trailing PE of 17. It's profitable. It's growing earnings. They help fabricators and foundries with cleaning and testing equipment. So it's a lesser known firm, but it's kind of interesting way to approach it if you are waiting or expect NVIDIA to chop around for a bit. I call it like the NVIDIA rental. It's a substitute. So at some point when this rallies and you get back into NVIDIA when NVIDIA is going down, because I think the asymmetry is an important point here, right? Like what's the downside versus the upside? I look at this and I say, well, downside's limited. Upside looks attractive. So that's that. Shall we shift gears, Nick, and talk about ETFs and why ETFs are just amazing from an active management strategy and tax? You and I have been talking about this for the last weeks.
And I think it was in both of our minds for a while too, in terms of we both, I think, arrived at the same conclusion of you can do whatever you can do, but at the end of the day, it comes back to a tax strategy, right? I mean, not everyone's going to have the funds in a retirement account and run a separately managed account where they can do like a model portfolio. And just from a trajectory of where things were going in terms of mutual funds to, we can break out the mutual funds to a separately managed account for you. We can do indexes. We can do custom indexes. We can do this. But then generally, though, when we move away from indexes, when it's more research-based, when there's more active management, there's not an easy way of keeping up with the trends in a tax-efficient manner. And that's why kind of all roads lead back to the ETF.
So why is an ETF better than a mutual fund?
One main difference with an exchange traded fund is how they do new shares in terms of creating new shares or redeeming shares. And they can do that in basically to minimize taxes. They can use what's called an in-kind creation and will allow them to kind of transfer stock or trade stock as is. So they're not creating a taxable event as they're updating the index. And since now anyone can create an index, what is an index? It's beyond just S&P 500 or the NASDAQ. And as things are going, if you have a process of saying, okay, we can take these baskets of very high or low cost basis, a lot of taxable gains embedded, and we're able to swap them out, but we also have flows going in and out of these ETFs at the same time. So you do have these older investors, newer investors. So creating an ETF in itself gives a great opportunity beyond just looking for an ETF that's currently on the market as well.
I agree. And I'll play that back. Look, if you have, say, NVIDIA or Bitcoin that's highly appreciated and you don't want to sell it, you don't want to pay tax. That's partially why you don't want to sell it. And maybe you believe in the thesis, but you say, gee, I'm way overweight on this asset. Then you can vend your securities into an ETF and then get delivered an ETF and not pay tax. That's what this in-kind transaction is. That is a massive tax opportunity. I can't say that enough. I mean, that's just a massive tax opportunity, right?
And on top of that too, it's also allowing to run systematic strategies on positions that you already own. I mean, we were talking about NVIDIA. It's a great example because everyone knows it, everyone understands it, and they have this potential. But what if it goes sideways? Well, that in itself is a trading strategy in itself. If something is showing itself to be in a trading range, there's a lot of advantages of writing kind of cover calls or cash secure puts or ways of entry or exiting a position. So having that run an ETF, yes, there's going to be some taxes. We're not saying that they're purely like, oh, this is great, but but the advantages far outweigh just trying to do it yourself. Especially if you believe in the concepts of what is being added or being removed in terms of the investment philosophy behind the actual ETF. And that, I think, is what I'm most excited about too. There's nothing really on the
I agree.
available now that has all those. There's things out there that all kind of touch on these different themes, but there's nothing that's really saying this is one encapsulated way of just getting the entire breadth and depth of everything.
Right. Well, I think, look, having markets today with this hot ball liquidity that's bidding up asset prices quickly, and then it moves on. We see that in a lot of places, right? Dell ran up 100% in the first 4 months of this year. And we looked at that and we bought it. We own that. And we said, okay, this thing is more expensive than it's ever been in its life, looking on a trailing PE basis or even forward PE basis. So we want to sell this, but we don't want to pay taxes. We want to sell it from a risk management perspective. We want to rotate it. That's what you would do if you didn't have to consider taxes. So we sold it. The stock reported earnings and it dropped 20%. So it was a good decision. But now we have to pay taxes on that.
Yeah.
So NVIDIA is a good example. So we had, I'm going to call it the Cathie Wood top last Wednesday. If Cathie and I ever meet and do a selfie, it'll be like a positron and electron coming together. Like the simulation will end. It's going to be amazing if that ever happens. But in any case, we had the Cathie Wood top last week. You can see it on the screen here, right? I think she was buying some semiconductors like AMD and TSM and an ARKW fund, I believe. And you can see this coming a mile away. Of course you want to de-risk. And if you look at how overextended NVIDIA is, of course you want to sell. But if we do, we pay taxes, and a lot of taxes, right? Because we have a low basis. Now, here's the point. If the strategy is wrapped in an ETF, the ETF can be dynamic and it can buy and sell. And those taxable gains are not being passed through to the owner of the ETF. The owner of the ETF, they log into their Fidelity, Schwab, Robinhood account. They just own that ETF. They're not going to pay tax until they sell the ETF. So the point is, what would have been taxed gets transformed and accrues value. This is massive. So it benefits active strategies the most.
Yeah,
that's the key takeaway, right?
Yeah, and it's called a heartbeat trade. Is if folks want to look into more of it, but I mean, again, for everything that active managers are trying to do, this is probably, why not take advantage of the vehicle that's being handed to you, right? I mean, it just makes perfect sense.
Right. And of course, folks that own, let's say, VOO, Vanguard's S&P 500, they know this. So you're not paying taxes every time the S&P 500 rebalances, or if they drop a name and then they add a name like Apollo to the category, the S&P, you're not paying taxes on it, which is massive. So,
or transaction fees, because you're not actually buying or selling.
Right. You're not paying transaction fees. Like, look, eventually there will be a correction and there'll be a risk-off market. I don't think we're there yet. We talked about some of the kind of risks, but if you can de-risk or rotate within an ETF and not have to sell the ETF, that is absolutely massive, right? Like, imagine there will be a time when we look at, say, BAML's flow show report, or we look at sentiment indicators like the AAII net bull bear ratio. It'll be like 2 standard deviations above. You're going to see the ARK ETF at like a high, right? You're going to see unprofitable tech ripping. You're going to see retail open to buy options at high. Those are all the telltale signs of a market top. Maybe IPOs are back and bad IPOs are back. That's a sign of a top, right? SPACs. We saw all that. in 2021, by the way. We saw all of that in late 2021, right? Sometime like that will happen. And we're going to look around and say, okay, well, what do I do? Do I sell and pay a boatload of taxes? Or do I just suffer a drawdown? And the answer is, well, if the strategy is wrapped by an ETF, then you have an answer. The answer would be to rotate. That's the answer. Rotations give risk management support, right? Because you're rotating to something that has more upside and less downside. For example, we rotated to energy 2 weeks ago. And okay, I'm not worried about energy stocks. In fact, the seasonality for energy is very good now. And then, of course, you have the commodity rally that we talked about earlier. So, yeah, we're excited. I think Nick and I are going to do a show dedicated to really exotic ETFs too. There's so many interesting ETFs. Do you want to describe one or two of those as a teaser, Nick?
Yeah, I would say there's going to be active management, and then there's going to be the passive investor that's going to say, I just want to have market level returns. And good for them. But even in that situation, there are now options that are being embedded in these types of investments that allow you to trade off upside versus downside captures, right? So they're basically buying protected puts, selling cover calls, or basically collaring a position around a certain level. What they're basically doing, like a company like Innovator Shares, is creating risk-defined ETFs similar to what you see in annuities without the annuity wrapper. So you can get the same level of returns without necessarily paying higher expenses going through the annuity route. So I that's one example. Others are basically paying like out of the money put spreads for a way of providing some sort of like a positive return in a very negative market, in terms of more of a snapback market, where if something is more of a market crash, like a 5% is not really going to cut it. But if it's a 10, 15, 20% market correction, then those types of investments will go up in value. They're using these in replacement, again, from what Ron was saying. Instead of trying to sell the positions or collar the positions or do that, there's like, okay, if we can add it as a portfolio level, then this can maybe offset that, and is putting in advantages on the portfolio, in my opinion. There's a benefit to it, but it's not solving the systematic issue, which lies at the center of many people, which is when they sell, they know that they have a guaranteed loss. So how do they mitigate that loss? Most people can ride through a 5% correction, even 10% correction, if they know it's going to eventually come back. But if they're going to sell 20+% in their taxes, then they're like, that's never going to come back. So we need to solve the core issue first.
Absolutely. So we're going to build a website called LumidaETF.com. Stay tuned for it. I'm really excited about this. I mean, it plays so well to our approach because we can be nimble. By the way, I don't want to be nimble. I like to own stuff for a long time. But the current market condition is that there's a hot ball of money sloshing around. I like to buy low and sell high. If you break it all down, now we have a framework on how we do that. But like if Dell goes up 100%, I'm going to sell it. I expected that in 3 years, not 4 months, right?
Well, that's because you had metrics, right? And that you avoid the emotional side point, because most people, when something goes up 100%, unless they have almost like a rules-based approach, like, okay, I'll sell half, but what if you sold half at 25% up or 30% up? They don't know. Most people don't have a set discipline to sell things. They'll buy things, but they don't know when to sell. And when they sell, they don't know when to go back in.
I agree. People have been trained to buy the dip. By the way, buying the dip doesn't always work. Look at Lululemon, by the way. So look at PayPal.
And PayPal had a good narrative there too. So it's not as easy just looking at like, oh, wow, but there is more to it. And having a process behind it and knowing why you own what you do versus comparing it and saying, is there something that's better? So this could still be good. The stock, stock A could be really good still, but potentially versus 3 other alternatives that are way better. And then what happens is you wait and you wait and you wait, and then you sell it at the worst possible times.
Yeah, no, I agree. And look, if you be tactical, especially if you have a volatile asset, right? Like Ethereum is a good example. We wrote this on Twitter. We sold ETHE in May. That was the conclusion of a wonderful chapter of these incredible discount to NAVs where you can buy an asset 40%, 50% less than its NAV. It was amazing. We sold that out. And we did a pretty good job with that. And part of that was because NVIDIA was reporting earnings. This NVIDIA correction hypothesis, that was kind of in the background. And then with where the dollar is now and these other, we're back, which is great. It's good to be back. But by the way, I'll show you real quick on why we didn't buy on Lulu. This is a good little tutorial here, but here's Lulu. Look at this thing in the dump. Look at Lululemon. This is just brutal. This is an accident. It's like rubbernecking, right? You just want to look at this like, what the hell happened? Here's what happened to Lulu. So by the way, the forward PE is 20, trailing PE is 23. Okay. The issue with Lulu is Fitch. I'm going to flip that up now. Abercrombie forward PE 19.9, trailing PE 23. By the way, back here, right, Lulu's rallied a good amount. I mean, sorry, ANF's rallied like double digits, 20, 30% just in the last 4 months. So back in March, when Lulu reported, ANF was the apparel market that was cheaper, and it also had momentum. So I contend that that's why Lululemon was not the asset that you should be buying. We wrote about that on Twitter. Last Friday, same thing happened. Lulu down 3%, Abercrombie and Fitch up 3%. And on March 23rd, we did this analysis where we say, hey, this is back 15%. Another thing is down 40%. It's painful. But the main point was that Abercrombie and Fitch had a 17 PE ratio and it has momentum. So why would you own Lulu? In fact, maybe you want to short Lulu and buy ANF, which maybe is what people did. I don't know. But that, will help, I think folks kind of think about different assets. And PayPal, the issue with PayPal, I haven't looked at it recently, but the issue with PayPal is that there's another business called PaySafe. Okay, so it's the same story. PaySafe was cheaper and it had momentum and it had better earnings growth than PayPal. So why would you buy PayPal? And it takes time for those imbalances to get worked out. But the investor market does pay attention, and over time will start to price securities efficiently. So if you want to buy PayPal, you have to look at PaySafe because that's the opportunity cost of owning PayPal. Here's real quick. This is on we wrote about this on March 10th. So PayPal, everyone's talking about PayPal back then. All these stocks were going faster than PayPal. PaySafe growing 9%, and it was dirt cheap, 4.7 PE ratio. Let me show you PaySafe now. Shift tabs here. This is PaySafe. So we looked at March. That was here, right? March 8th is there. That's about $12. Now it's at $18. One of the mistakes I made is not buying that after we did that analysis. So we should not buy PayPal because PaySafe is better. And we did not buy PaySafe. That was a mistake. But the reason we didn't is because we think payments is crowded. Here's March 8th for PayPal, and PayPal's in the same exact spot where it's been. So what else? Any questions from the audience? We can talk through a few quick names real quick. If you want to send one in and we know it, we can talk about it, or Nick and I can just continue to shoot the shit. I will say
there's a question on Tesla too. Yeah. Oh yeah. Ellen Chenier. Yeah. That's a good one to talk about too.
So I actually sold this morning, by the way, when I disclosed that we bought it with that green line. And the reason why it's like this, it's like a debt, right? Like that's a move that would take place over a long period of time. And I think I can get it, look, I think it'll do fine. It's a good business. Energy, commodities linked to the power, powering of utilities play. Now, natural gas is the least dirty energy as compared to oil and coal. And these data centers need utilities to power them. Utilities need energy. Solar is not enough. So there are a couple of plays in natural gas. And so, yeah, we sold this morning. But by the way, when I sell things, usually I'm selling them too early. So, you figure out what I do from here. But I'll give you an example of that. I don't mind selling early because I know I can find a rotation. It's early in and early out, and it's a form of risk management. But if you look at Harrow, is very interesting. So Harrow, they reported earnings on March 20th. This is another good little intel, by the way. So inside, just how do you think about investing profiting from the mistakes of others. So this big deep red candle. So Harrow had been in our coverage list for a while, right? We didn't own it. We saw earnings come out and the stock dropped 10%. And we realized it dropped because they didn't release their earnings filing. And so all the algos, I contend, just sold off this stock. Then they released their transcript 2 hours later. We read it and they delayed the release because they had a major partnership that they wanted to announce, which they inked the day before. And so then we said, okay, buy this thing. And it started rallying from negative 10% and almost entirely closed the gap. And then, this ran up 20% at this level. Then it round tripped, which was really frustrating because essentially we were up 20% or we gave it back. But then it went up again 50%. We sold it here. But then it went up another level. It's actually up 100% from this level. It's insane, kind of incredible, up today as well, right? But now it's almost back to its peak valuation. It's done 64% in the last 3 months. So, just sharing a little bit what we are doing. And the main point here is that in this market, I think if you're not tactical, you're leaving value on the table, but then you've got to contend with taxes. So therefore, if you can wrap in an ETF, that makes sense. That's why LumidaETF is coming. LumidaETF.com. We're going to get like a Dollar Shave Club. So stay tuned for that. And then when you see that, you can type in your email address. And, if you want to vend in securities that are appreciated, like NVIDIA, you can do that. But we're having a strong year. And if you look at, by the way, Visa, here's another call out. We bought Visa this morning. The greatest business in the world. I wish someone would disrupt them. I hope stablecoins do. I hope Congress gets their act together and enables the United States to advance U.S. global dollar hegemony with stablecoins and a rational digital asset policy. But until then, Visa is one of the best businesses in the world. And
more than likely they'll
so
both
Visa
themselves. Yeah.
Right.
Visa and MasterCard, yeah, they're going to be around. They're just going to adapt. I think stable coins are very disruptive, but also probably very beneficial, going back to the EM kind of debate again.
Right. Well, they both have crypto strategies, and they both have very capable crypto teams. And I've met Guy Sheffield at Visa, super impressive individual. I used to work with them back when I was at Cross River. They have thought a few years ahead, not more than that, around how to interact with crypto. And so they control the endpoints. They control the point of sale terminal with the merchants. And they have minimum standards you have to be if you want to be in the Visa network, which if you think about how that can interact potentially with the stablecoin, I think there's a lot of opportunity that Visa might have. But these are both selling off because there is a settlement, and it has to do with Visa, MasterCard having to pay back merchants to the tune of tens of billions of dollars for overcharging the interchange. And the liability could be significant. I guess one way to look at this, though, is that their market cap may have priced in some of that simply from the drop of 270 to 265. So, that's maybe not quite actually. We'll see. I have to see. There's uncertainty around that liabilities, but I think it's an interesting idea. We'll see, right? This is not going to be like a high growth stock, but I don't know why anyone would want to own a bond. Like if you are risk averse, like these kinds of businesses are going to be here for a long time, and they're real assets, are not paper assets. Inflation eats away at paper assets, and real assets like stocks, like housing, they will ultimately bake in inflation into the price of the asset. That's economics 101.
Especially when we're talking about globalization and technology. Technology will be deflationary, which will also benefit the businesses that are able to capitalize on cheaper, faster, stronger, all the different areas that people will adapt to the new tech, because at some time it'll just be the easiest way to go. Most of this crypto technology is just going to be embedded.
Oh yeah,
and
like
people won't even think about it. Yep.
No, I agree.
Exactly.
There's a startup.
DOS command line.
There's a startup in Argentina where there are people that are afflicted with this double-digit rate of inflation. I think the new president is starting to get things under control. Kind of amazing to see what's happening there. And this app you can download from the App Store, and you get paid in US dollar stablecoin. That's amazing. You're improving the outlook and livelihood of a family that's trying to save and not give up their wealth. So
yeah,
there's
like the switching cost isn't there here in the US. It's why do I need, this is great. I can just, do Venmo or whatever. And that's where people's kind of viewpoints are, is why change what's not broken. They just don't see all the fundamental issues behind it that could really be a benefit. So I think the EMs, I think the emerging markets will be a very interesting area to watch with all these different kind of converging factors.
I think, with the dollar rolling over, I agree, especially with that in place too. So you said we had a question on Tesla. What was the question on Tesla exactly?
I think just your thoughts on it. I think that was just
all right, quick thoughts. So Tesla is the most expensive name in Mag 7. It's got a forward PE of 76. It's getting more expensive next year than this year, by the way. Generally, you want to see 4 PE lower than the trailing PE. That means you have earnings growth. That's one. It's more expensive than NVIDIA. Let that sink in for everyone. That should give you like a shudder. So NVIDIA is growing faster, right? So it is benefiting from this negative momentum rally. That's what's happening with Apple and Tesla. So part of this is like a time horizon question. And look, it's up 7%. I think when Tesla reported, there's so much bearish news on Tesla that anyone that wanted to sold. So it capitulated, sellers were exhausted, and now it's rallying. But other people are getting back in now that are trying to momentum chase this thing higher. And those are weaker hands, by the way. They'll keep doing it. Even now they'll keep, because it's about to break them. It could keep going. I'm speculating. I don't know. It could keep going, right? But the fundamentals around Tesla are deteriorating. They've got competition from Lucid and Rivian. By the way, great podcast to listen to. Masters in Business. Barry Ritholtz interviews the CEO of Lucid. Check it out. It was really interesting. I listened to it this weekend, and I enjoyed that. By the way, that guy's voice is like one of the best voices ever. Like you could almost fall asleep to it or go into like a deep meditative trance. If you ever have trouble sleeping, if you can do like an ASMR mashup of the Lucid CEO on that podcast, I think, it might help you get to sleep at night. Humanoids are the bull case for Tesla, by the way. Humanoids. It's not the EVs. EVs are in a bear market. Pick a stock, any EV stock. It's in a bear market. Okay. We've got this counter trend rally that's underway, but the fundamental trend, is bearish, and Tesla needs tariffs on China to compete, because otherwise BYD, which is a Buffett-backed company, is going to ship EVs to the United States at $10,000 unit pricing. We're going to have Tesla earnings coming up in July. I don't think it'll be that great, but I think what happens here is, hard to say. Again, the first 2 weeks of July are very bullish in general for technology stocks.
Yeah.
But I'm looking at things as an investor, but I also like good entries. So I do try to think about things tactically, so I'm not overpaying. I want good asymmetry. I want more return relative to the risk. Nick.
No, I think that's a good thing. Me personally, I would never short Tesla, because you just don't know what's going to come out of the. I think when you're dealing with someone that is a creative genius like that, it's just a matter of what gets translated to the bottom line at what point, and what will, from a personality standpoint, I think they'll have a dramatic effect beyond everything that we can look on paper. But to your point, I agree with you in terms of there's other things that are out there that are probably capturing my attention, unless someone is just such like a perma bull on Elon, and then there's ways of kind of looking at ways of kind of mitigating some of the downside there. But again, that's moving away from long-term investing to more tactical trading like that, which is a name and a narrative that I think from a trader is a lot different than someone that's looking to just be more of a longer-term hold type of mindset.
Also, you had executive turnover at Tesla.
Yeah.
Multiple. If you believe the upside's there, why are you leaving? Is it disassociation? There are risk factors around Tesla, I would say. Look, do you believe it's going to outrun NVIDIA? No, I don't think so. So that alone disqualifies. Same thing we talked about earlier, Abercrombie and Fitch versus Lulu, PaySafe versus PayPal. That relative value analysis will keep you out of trouble.
Agreed. And I think from an emotional standpoint and a conviction standpoint, it's hard sometimes to let go of these narratives that are so strong. It's beyond just the narratives. I mean, I think that's the biggest takeaway from this too, is you can look at the narratives, then you have to combine it with the factors, but then you also have to look at the underlying kind of the rationale under what's actually happening with the company. Again, we go to like HRO again, in terms of there could be reasons why things are reacting that are just completely easy to explain, but an algorithm is not going to wait for that data. It's just going to make a decision based off the data that is available.
And I think some of this is like you have some short squeeze behavior happening.
I definitely agree with that. I think that's going to be, I think Bitcoin miners are going through a little bit of that now too, in terms of just this whiplash effect of, oh wait, now they can be used in what, data centers? And so I think there's this kind of opposing viewpoints that are just clashing on these names. So I think that's it's like a battlefield, right? So then it's a whole different, like, do you really want to pay into using your time and energy in a battlefield stock, or is it better to just look at where people aren't even looking at?
Why get in
why
battles?
fight? Yeah.
Why fight? There's really no point. Avoid battlefield stock. SoFi is a battlefield stock, but I don't have a position in it. I don't like it. I had a view and a position on it when it wasn't a battlefield stock.
Mm-hmm. If it's a battlefield stock, it goes into the GameStop or the other narratives. It's not good or bad. It's a different approach.
I agree.
Yeah.
The GM is not a battlefield stock. GM is absolutely not a battlefield stock, right?
Yes. Right. Yes, exactly.
Look at GM, right? So maybe GM was a battlefield stock back when it capitulated, but this is not a battlefield stock. Why do I have to get into some debate with someone else about GM? It's ignored and overlooked. And it's gone up like 30% plus year to date, outpacing QQQ and S&P 500. And they just announced more buybacks. And it's a boring boomer stock. I love it, right? So
yeah, it changes, like, in terms of what else is out there. If you don't have to exert all your time and energy fighting every single rationale or this back and forth, and you can just look at the things that people are ignoring or they're just not exciting, the boomer mindset. I think that's true in any type of technology too. I mean, when we look at DeFi and we talk about things, there are boomer mindsets there that can really help that people are just overlooking or just gave up on.
Right. I agree. Look, battlefield stocks are priced efficiently. That's the takeaway, because they're so highly covered. They're so analyzed to death. So where's your edge going to be? Right? If you got 10,000 people talking about this thing every day, and I don't see
every angle, from every single potential, right? Every what if, could have, would have, yeah. It's
like you have to have ego if you want to say, I'm going to own this battlefield stock. You got to have a lot of ego, I think. You're like, oh, I really have a view that's going to outperform the 10,000 people studying this thing. Right. But like, okay, Tesla, real quick, I'm going to share this other idea. So you see these lines here? This is a pretty interesting study that we did. We have lots of little studies. We're on Tesla, so I'll explain what we did here. So these lines are option expiration dates. The third Friday of every month. And Nick knows this. Nick's a pro. He's been at Merrill quite a long time. Then he went independent. And we've teamed up to provide crypto white glove service, by the way. So it's all convenient. You get a prompt on your MetaMask or Coinbase wallet. You control your keys and you get a prompt and it says, hey, we recommend you buy or sell this, and you get to approve that decision or not. So Nick and I
self-custody at all times. That's the core there. Self-custody, non-discretionary. You choose what trades you want to do.
I believe we're the first SEC registered advisor to execute that, by the way, which is super, super cool. That's a first for us. We'd had another first on AI over the weekend. We'll come back to that in a moment. But okay, back to Tesla. So these lines here are option expiration dates. So options expire the third Friday of every month. And notice here on August 18th, I have a green bar here. You see Tesla that day. And then on the next one, Tesla tanks. The red, another option expiration date. Forward is a holiday, it's a little bit more space. I went a little bit more than kind of put up. The general point here, then look at most recent earnings, the last two, right? Option expiration date, and then it rallies, and then before this option expiration date, then it rallies before tanking. I would overlay, if you're looking at Tesla and any stock that's heavy options trading, you want to look at the option expiration date, because sometimes they can be an inflection point. The times are more likely to be an inflection point is if the trend going into the options expiry is strong. So if you look at Tesla, You had a strong downtrend here, option expiration, it flips, strong trend, flips, downtrend, broke this 200-day moving average here, right? There's no real trend here, kind of mixed. So now the causal reasoning for that, from a first principles perspective, is this. A lot of people are writing calls and puts on these names. So if you have puts on Tesla, let's say Tesla's in a downtrend, you can bet there are a bunch of hedge funds that own puts on Tesla for sure, right? So on options expiration date, if you're in the money, those options are not cash settled or liquidated from your account. That doesn't happen. You actually put the shares of Tesla. You put the shares of the thing you didn't want to own. Think about that. You were sure you bought puts, you made money, and now you're put this quantity of Tesla shares, and the value of that, it will show like that P&L gain. But now, you're put a negative position in Tesla. I should have been more clear. You are put a short position in Tesla, which makes sense. If you own a put, you are short Tesla on leverage. That's what puts are, right? So you are put a massive negative short position in Tesla. And my thesis is that causes short squeezes because people don't cover, or they don't cover fast enough. So imagine many, many accounts suddenly being put in a negative short position on Tesla. And now it sets up these short squeezes. Anyway, so.
Yeah, and then when you combine that over with earnings states, and then you suddenly have a nice kind of emotional kind of diametric shift between earnings and expirations. It just that's the battleground. I mean, that becomes more, again, short-term tactical. What do you do with knowing that everyone? I don't want to use the word zero-sum game because it's not true, but it's much more. The odds are much higher and quicker, I think, is a better way of saying it, versus just owning something that is just been completely discounted, ignored, and I wouldn't say free alpha, but it's research-based alpha.
I agree. Look, you want to stack. I call it stacking edges. It's this idea of having as many probabilities going as possible. By the way, look at ASPI up 10% today. You could bought in at $3 today for like an hour. It was hanging out there. Actually went down this morning. This was our latest call. So we own ASPI. I think it'll do well. I interviewed the CEO last Thursday and said, yeah, I think I want to buy this. Although I bought it a few months ago too. We wrote about it in the Lumina Ledger newsletter a few months ago, but you might want to look at the interview for that. But that was cool. We're on a roll, Nick. We are on a roll. It's kind of stupid.
Yeah. I mean, we should definitely. I mean, it also, when you have things in your portfolio that forces you to learn something new, if you have a learning mindset, you're going to learn more than you ever knew about medical isotopes and how they're essential, and where the market, supply, demand, what happens with geopolitical. Everything starts connecting the dots in terms of geopolitical risk. What's happening with Russia? Who are the resources? Who owns South Korea manufacturing capabilities for nuclear? Who's building in the UAE? All those things start to get wow, everything is interconnected. We need power plants because our capacity to build energy here in this country is peaked out. We need more power. I mean, going back to what Ron was saying with LNG, with gas power, it all interconnects.
Well, yeah, there's this post called "Follow the Money." You can Google it, and we wrote exactly about that. That was the basis for our LNG thesis, right? So we owned TLNE, we owned Talon Energy. Let me show you Talon Energy, by the way. We're excited, we're having a good year, but when I look at things like this, there's another part of me that just feels uncomfortable. It's these massive moves in short periods of time. We saw that in 2021, but not 2021 was more exaggerated than this. This is 2021. This is the Talon. Sorry. Look at this move, right? This is like 75 to 15. So what's the math on that? Look at Constellation Energy. Like these are utility companies, right? Energy. These are boring companies that are highly regulated. They have like 10-year planning cycles, and they're moving like tech stocks. Really, really interesting, right?
I think it's the mindset of folks thinking like, rate hikes are over. We don't know exactly when they're going to cut, but these are heavily laden debt companies. They're going to benefit from lower interest rates. They're going to benefit from the high energy demands, partnerships with some of the bigger companies that are out there. Somebody's going to need to build these new power plants, and nuclear is part of that equation. We just don't know exactly what, but
nuclear
nuclear
is slow to come online. That's the issue, but there's still investment around the category for sure.
Absolutely, and investment around the companies that are building the nuclear power plants too. So
I agree.
I think that's going to go full circle.
Okay, this is a follow the money post. This is like the basis for the liquid natural gas. It's just like you go downstream. What you have the app layer, the hyperscalers are spending on NVIDIA chips, and they're building out data centers. Data centers need utilities. Utilities need energy. So what's after utility? What's after liquid natural gas is the question. Or like there are other LNG plays out there too, actually. So, but infrastructure is an interesting idea. I would say there's an ETF called Grid I've been looking at recently. I have not bought it. I'm researching names in this category. So Grid is a clean edge smart grid infrastructure index fund. So it owns a number of companies that are responsible for investing in the electrification and upgrading of power transmission, power generation, power storage, right? That's what we need. The American electrical system is outdated and it needs a retrofit. So Grid is one of those. Grid as an ETF, by the way, fun fact, has outperformed the S&P over like long periods of time. Interesting, right? But I got to find the right ideas in this because Mr. Market has sniffed this one out already, and I don't like to chase, but it has pulled back, so it's getting interesting. You can see some of the holdings here. If you go to holdings, and there's quite a few. Some of those names we know, and we've been quote unquote stalking them. I won't name which ones they are yet. They don't have good entries yet. Some of them are in bear markets. Some of them are like overbought and pulling back. But there may be something to do around that category.
Just a random thought that's occurred to me is with the Ethereum ETF on the horizon and folks saying everything is open source now, everything is like open discussions, open thoughts. Here we have a little more of an open research in terms of things that we're thinking even before they're in the portfolio. Most times you hear asset managers talk about things after they know they've kind of had a home run. They don't really talk about things during or before. So I like the open. It keeps you much more engaged in the process at all times. So just worrying about just kind of being inertia, I think, is a big detriment to a lot of strategies that are out there.
Complacency, inertia, the feeling of safety from being in the herd and doing whatever else is doing. That's the enemy right there.
Throwing something out there and saying, okay, well, here's a thesis. It doesn't really fit nicely, but it actually would make a lot of sense because that's when you're early in the right way. Instead of,
I agree.
It's very hard to be a trader trying to be early based off of a pattern or setup because everyone's looking at what you're looking at. If you can combine.
I agree. Consensus can work sometimes. Like the S&P 500 is consensus and it works. I'd be long. I'd be long the United States, the best businesses in the world, sure. But that's different. Consensus is more about, is it priced in or not priced in? There's no such.
Correct.
With the S&P, it's more around, is it overvalued or undervalued?
And that's
a different question. It's an asset class question. Would I rather on the S&P or some alternative asset?
Right.
It's a different lens. But I think you can absolutely beat the S&P. It takes a lot of work. It's not for the faint of heart, and most of you should not do it. And you should tax loss harvest, and you should do all these other things. Like, it takes a lot of energy, time, and focus, and research, and like you said, continuous learning, and but it's absolutely doable for sure. And what else? Should we leave it there, Nick? Or
sure, yeah, I think we covered a lot this time around. I mean, a lot I think will be happening in the next couple of weeks here too, in terms of just political, economic factors coming out. But I'm very excited about the ETF. I'm very excited about the DeFi, the non-custodial ability to kind of work with clients across all the different specters of asset classes, not just traditional finance anymore.
It's exciting to see the turnaround in digital assets in the pace of a year. So really, really quite extraordinary. Well, thank you, Nick. We'll have to do it again and soon. All right. Be well, everyone. Take care. Make it a great week. And happy July 4th and long United States. Mega long United States. All right. Take care.